Welcome to this week's View from the Top. Our interview is with Roger Crandall. He's the chief executive of MassMutual. Given that both major party candidates in the U.S. presidential election this year are talking about entitlement reform, it seems inevitable that some kind of cutbacks are inevitable to Social Security, Medicare, Medicaid. For somebody in your business, in the insurance and retirement services business, what are the challenges that presents?
From a retirement provider's perspective, I think one of the things that's going to do is highlight to people they need to take care of themselves. The most important thing everyone can do is start saving money. If you work at a company that has a 401k plan, max it out. Make sure you take advantage of the company match, because starting the journey of saving for retirement is the whole key. We've done some research that shows for younger people it doesn't particularly matter what you invest in, it matters that you invest. So 80% of getting to your destination is about starting the journey. So we think ultimately the U.S. government, both federal, state, and local, are going to be reducing entitlements. We think that happens over probably 20 or 30 years. So if you're 62, the chances of your world changing dramatically are low. But if you're 32, the chances of your future world changing are probably high. So we think it's a great opportunity for the retirement industry to help more Americans reach their retirement goals.
Do you think that interest rates need to be higher? Has the Fed been on hold for too long?
I would love to see interest rates move higher, ideally because the economy is getting stronger. But the situation we're in right now with global uncertainty causing people to flood into U.S. Treasuries seeking a safe haven is, I think, certainly a real bad thing for savers. Frankly, what's happening is borrowers are benefiting and savers are paying. And as America continues to age, we have 40 million people over the age of 65, 10,000 people entering retirement every day. They're all the folks that are getting hurt by this. So I'm not sure it's explicitly a Fed policy situation, but I would love to see rates move higher, and again, ideally because of economic growth.
Do you think that the approach that they're taking to the sovereign debt crisis in Europe, austerity, is that the right approach?
I think ultimately structural reform of some of the countries is key. I don't know how some of these countries are frankly going to be competitive with the euro going forward. But what's happening in Europe is unfortunately, I think, a long-term problem. I have not heard a single good solution to what's happening in Europe. So I think we're going to be dealing with the challenges Europe has, not just over the next 30, 60, 90 days in the context of Greece, but I think we're going to be dealing with them over the next 3, 4, 5 years in the broader context of how does Europe move forward, given they've got a low growth environment and they've also got a real demographic headwind. Remember, many of these countries have not had birth rates that have hit replacement for 20 or 25 years now. So they're aging rapidly, their entitlements are out of control. It is a very difficult situation. It's the thing that gives us the most concern right now about the global economy.
Another symptom of this seems to be that countries are asking banks to hold more capital, to cut back on their risky activities. As a major counterparty to many of these banks, how is that impacting your business?
Yeah, I mean, in terms of the quality of the U.S. banks, I feel better about the financial strength of U.S. banks today than I have in the last several years. So might they be downgraded by the rating agencies? Yes, they might, and that might impact how much collateral they have to post with counterparties. But I feel much better about the U.S. banking system today than I have in several years. The European banking system, on the other hand, a different story. I've got less comfort that some of those banks have dealt with some of the prices that they're carrying some of their assets at. And that's why you've seen the ECB have to step in and provide the LTRO to really stop what was a run happening on the European banks. Now, they've helped solve the liquidity problem, but the solvency problem, I think, still continues. So I think we're going to need to see a lot more capital go into the European banks in particular, most strikingly in the case of Spain.
You mentioned the possibility that a rating agency might downgrade another U.S. bank. Do you think this is the right time for rating agencies, given the environment, to be downgrading?
Yeah, I think, and I started my career as a credit analyst, so I don't think there's a right or a wrong time to upgrade or downgrade companies. I think you've got to have a consistent approach, and then you've got to apply it consistently over time. Is it a good time to downgrade? Frankly, as a financial institution, I can tell you there's never a good time to be downgraded. But I think actually it's more important that the rating agencies look at the facts and be consistent in their approaches. And I think they've actually improved dramatically their transparency about how they're looking at things. The fact that we're having this discussion, wow, it's possible that the rating agencies are thinking about downgrading the big U.S. banks because of changes in their rating criteria, that's a good thing.
Thank you, Roger. Now we're going to play Long Short. It's a long tradition of the Financial Times. Are you ready?
Great.
Greece and the euro.
Short.
Mitt Romney winning a swing state.
I'd say long.
The Boston Red Sox.
Short.
Okay, how about the New York Yankees?
Long.
Paul Ryan's budget.
Long.
China owning more banks in the United States.
Long.
Roger, thank you so much for your time.
Thank you for having me.